A very warm welcome to the press conference of the In Gold We Trust Report 2021. My name is Mark Walek and this is my colleague Ronald Stöfferle.
Good morning from Vienna. It's a great pleasure having you here at our press conference in Vienna. Some person are here in person, but most of you are viewing us, watching us online. So hello from Vienna. I know that people from all over the globe are watching us. Hi, Michael in New Zealand, kia ora, good to see you. It is a great pleasure presenting you now the highlights of our 15th annual In Gold We Trust report. The title is Monetary Climate Change. It's a bit of a provocative title, but we said while everybody is talking about ESG, SRI and so on, we would like to talk about the things that are actually happening in our monetary system, in the interplay between inflation and deflation, and how it affects your portfolio and especially the price of gold. Ladies and gentlemen, as you know, the In Gold We Trust report is quite a brick. It's this year, I think we didn't make an all-time high. It's only 350 pages, but still it's lots of work, and it wouldn't be possible to publish such a huge report without the support of our dear team. Some of them are here today. Thank you very much for your tremendous work, especially Gregor as the editor-in-chief, Janine helping us with all the work for our premium partners, Fabio and Philip, Richard, who is not here, crunching the numbers and so on. Altogether, we are a fabulous team of more than 20 people, and we are very proud about what we have achieved this year again. Some words perhaps on the new things in Gold We Trust. First of all, we've got a completely new layout of the compact version. Many people criticized us and said, well, you know, your compact version is still 80 pages. That's quite a lot. That could be an extended version for other reports. So we said, okay, this year there's a new design of the compact version, and it is only the introduction and the conclusion of the big report, the big In Gold We Trust report. Then we've got new infographics. You can find them on our webpage. We've got Twitter threads prepared by our colleague Peter Young that will basically highlight all chapters of the report via Twitter, which is obviously a quite important channel for us. We will publish the In Gold We Trust nuggets going forward, and we've got lots of interviews and media work over the next couple of weeks. Now, as I've said, it wouldn't be possible without the fantastic support of our team, but it would also, and especially not be possible without the support of our premium partners. You can see them here. It's really the creme de la creme of the gold industry, the gold world. Fantastic companies that help us to finance this big project and to put out the In Gold We Trust report in English, in German, in a compact, in an extended version, and also in Mandarin since 2 years. Totally for free. So from our point of view, it is very, very important to educate people about sound money, to educate and inform people in a sober and honest way about what is going on in our monetary system, what is going on with the fiscal situation and so on. And this wouldn't be possible to give it out for free without the support of our dear premium partners. So thank you very much for your support. As you know, the In Gold We Trust report is published for 15 years now, and this year's leitmotif is the monetary climate change, and we will focus over the next 40 to 45 minutes about the key takeaways. But as you know, the weather forecast isn't too good for the weekend, so you will have plenty of time to dive into the big report of the version, which includes lots of interesting chapters. For example, we've got a fantastic interview with Russell Napier, one of my very favorite strategists. And he explains why he moved from the deflation camp to the inflation camp. We've got another interview with legendary blogger Fofoa. We've got a somewhat philosophical chapter asking the question, what is money? By Robert Breedlove, one of the, I would say, most influential people or philosophers in the Bitcoin space. We've got obviously a chapter about silver again. We've got a chapter about demographics, which is highly interesting and which will be a long-term inflation driver from our point of view. We've got a chapter that was submitted by Lynn Alden. She's definitely a big star in the US about long-term debt cycles. We're talking about ESG. We've got a technical view on the gold market. So as you can see, it is a really broad and diverse analysis of gold and everything that goes on in the gold world nowadays. Now, what's the executive summary of this year's report? First of all, that the monetary climate change is on the horizon. We're forecasting that increased inflation rates will not pass quickly. It is not an temporary effect that we are seeing. We think that real interest rates will remain negative for years, for actually many years to come. We will discuss commodities. Last year we said this might really be the opportunity of a lifetime. Now more and more people are talking about a super cycle in commodities. We will briefly explain what's going on in the silver market. We say that cryptocurrencies will not replace physical gold as a store of value, but it makes sense to add at least a small allocation of cryptos to your portfolio, as Mark will explain later on. Mining stocks will have the most profitable year in history in 2021. And our technical analysis is pretty bullish. The Kopok indicator is on a buy, and we see a so-called cup and handle formation with the price target at $2,700. We stick to our long-term target that we presented last year, which is $4,800 in a conservative scenario. We think that we are right in line, right on track to reach that. And we think that we will reach new all-time highs in the price of gold this year. Now, let's have a look at the performance. As you can see here, ladies and gentlemen, last year was a fantastic year to be in the gold space and to be invested in gold. Gold made new all-time highs. Gold was up in US dollar terms 25%. In euro terms, gold was up almost 15%. As you can see here, on average, gold was up roughly 20%. Now, since the beginning of the year, we're slightly down. However, in US dollar terms, we're already in the green area again, but on average, we're down 0.6%. But I think the most important takeaway is that gold did its job last year. Gold acted as a reliable defender. We compare it, many people don't understand my odd football comparisons, but I compared it to Robert Petzl, which was a very tough and reliable defender for my favorite team, Rapid Wien. And we said, well, gold actually really did its job last year. In this highly volatile year, gold protected or showed strength, especially in those extremely volatile days and weeks in spring last year. And gold very, very quickly discounted the inflation that was on the horizon. So all in all, we are pretty happy with the performance. However, many people were still a bit dissatisfied when the correction started last year. They say, well, what is going on with gold? And we said, well, you shouldn't expect too much. You shouldn't expect Bitcoin-like daily fluctuations and performance from gold. And I think, 25% in US dollar terms in just 1 year, that's a pretty decent performance. As you can see on this chart, the average price of gold made a new all-time high last year, and since the beginning of this year, we're already slightly higher, which is really important for the mining space. The miners, and we will talk about them a little bit later on, the miners really had a fantastic year in 2020 because their costs, their all-in sustaining costs were basically stable, while the price of gold was significantly higher. This year, the average gold price is even higher than last year. We've got an annual performance since the IPO of gold. So 15th August of 1971, 50 years ago almost, we say, well, we could also call it the golden wedding. Perhaps that's no coincidence, but 50 years ago, Richard Nixon temporarily broke the link between gold and the US dollar. Since then, on average, gold is up 7.9% per year. So we would say a pretty decent performance here as well. Well, what happened last year? After we released In Gold We Trust 2020, when gold was trading at 1,700, and by the way, Bitcoin was at 10,000, I think, exactly 1 year ago, gold really picked up momentum, and into August of 2020, we made new all-time highs basically in every currency. We shouldn't forget gold was making new all-time highs already before, but everybody is just staring at the dollar price of gold. And in August 2020, we made new all-time highs in US dollar terms when the price of gold peaked at 2,075 US dollars per ounce. Since then, we are seeing a correction, from our point of view, a healthy correction, because back then, sentiment was extremely positive. And it's no coincidence that yields, on this chart they are inverted, made a pretty similar move. So back in August, we saw the all-time lows in yields at 0.5% roughly in 10-year US Treasuries, and the all-time high in gold basically on the same day. And since then, yields went to 1.75%. And the price of gold made a double bottom at 1680 in March. Now, as you might know, at 175 for 10-year treasuries, the markets were getting extremely nervous. And more people were suggesting that the Federal Reserve has to implement yield curve control quickly. And from our point of view, at some point, this might happen. But the takeaway from this chart clearly is that the performance of gold and treasuries and so the yields are obviously highly correlated. And I think we all know that last year many taboos were broken, and we know that basically nobody really cares about those debt numbers anymore. 1 trillion isn't a really shocking number anymore. So the global debt burden grew by 25 trillion last year, and now we are at 281 trillion. So global debt to GDP is at 355%. Out of the G7 nations, only 2 countries have a debt to GDP ratio lower than 100%, which is Canada and Germany. Now, we know that the debt situation is here, and it probably we won't probably grow out of this situation. But the main takeaway for gold is the higher the debt, the lower the chances, the possibility that we will see rising real rates or significantly positive real rates over the next years to come. So based on the debt situation, I think this makes really a very, very strong case for the price of gold, because we analyzed in the last couple of years real interest rates, or rather the direction of real interest rates. That's probably the most important driver for gold. And as you can see here on this chart, well, those numbers are really staggering. We had a look at the two packages, the American Rescue Plan Act and the CARES Act in the US, both 1.9 trillion. And if you would line them up in $1 notes, you could actually go to Mars and back again. And at the moment, just as a side information, at the moment the distance from Earth to Mars is 330 million kilometers. So what we want to say with those infographics and those comparisons, the takeaway is big government is back. And if you have a look at the inflationary number of stimulus packages in the US and the sheer size of those packages, I think this should make a very, very strong case for interest rates not being able to rise significantly. And you can see it on this chart as well. The US alone has to refinance 8.1 trillion this year. As you know, quantitative easing is still 125 billion per month. In the Eurozone, we've got the so-called PEP program, which is 1.8 trillion, which will not end at least until spring 2022. And I think it's fairly obvious, and this is a point that we're clearly making in the report, that markets are highly dependent on permanent financing by the digital printing press. And now, Mark will continue with our views on inflation.
Thanks, Ronnie. Yeah, so this leads us to one very big question, which is more and more discussed by markets and by the public in general, and that is inflation. How are these issues concerned and related to the phenomena of inflation? And I want just go back a step first and remind everybody about this year's leitmotif. So the monetary climate change, what does this actually mean? Ronnie touched on a few aspects already, but we identified 5 major developments in regard to the monetary climate change. So number 1 is the budgetary nonchalance. Fiscal spending is on extreme high levels. It was pretty high in Western world before the COVID crisis, but the COVID crisis in general, in our view, triggered some of the already ongoing developments and ushered in this new monetary climate. Another very important point is the merging of fiscal and monetary policy. We saw a lot of indications that this is going on in various places of the world, but perhaps the most symbolic things that occurred is in the US, Janet Yellen, the former head of the Federal Reserve, became Treasury Secretary. So this is quite a symbolic move in our view, and that's actually something which was in the pinnacle of this unbacked monetary system. The independence of the central bank is basically the holy grail if one wants to have an unbacked currency successful. And so we see a lot of indications that there is some kind of merge going on between fiscal and monetary policy. Also, on the monetary policy side, there are new tasks being given to the monetary policy. So we see a lot of talk about climate change. We see a lot of talk about different objectives. For instance, also in the Eurozone, growth objectives are being discussed, especially in the US. It seems as if there would be more emphasis laid on the growth side and not so much on the price stability side. And we are also seeing the redefining of monetary stability targets. So in the US, the average inflation target was implemented last year, and in our view, it's very likely that a similar thing will happen this year in the Eurozone. I'm going to talk about this in more detail in a second. The fourth aspect of the monetary climate change is central bank digital currencies versus decentralized cryptocurrencies. So this phenomena is also picking up steam. And also the new ice age between East and the West. And we think all of these five major developments basically have direct or indirect inflationary consequences. So 2 years ago, this was a title on Bloomberg Business Week, Is Inflation Dead? And, oops. And, no. Okay, well, there should be another cover. This year, Barron's titled The I Word. So the inflation word is coming back into the media, is becoming back being discussed, and we're going to talk about this. So the main question is, are these already showing up inflationary trends going to be transitory or temporary, or are they going to be structural? So what we are seeing here is in the US, the CPI development during the last 20 years. And what's quite interesting now is that not only we are seeing a big acceleration of the CPI numbers since the beginning of this year, but also the fact that this acceleration is happening at the end of recessions already. So economies haven't even opened up really to 100%, and already now these inflation numbers are pretty high. So this is something what we want to point out, but also the fact that the velocity of money plummeted is a very important one. So this was being discussed heavily last year. All the expansionary monetary policy which was implemented as a consequence of the COVID crash in the markets in beginning of March 2020, wasn't inflationary right away. So that was especially due to the fact that the velocity of money plummeted. And this is stopped, this phenomena, and this could actually start to reverse. So in our view, there's a lot of potential here stored in the form of a lot of excess liquidity out there. And what happened historically, this is a chart which shows the M2, so a broad monetary aggregate per capita, and the CPI, the price inflation in the US. And one does see some correlation, but this correlation doesn't always happen in the very short term. So it can be, from time to time, there can be quite some lags if something happens as just happened right now, if one sees an extreme fall of velocity. But in the medium to long term, I think one can see that there is actually a connection between monetary inflation and price inflation. And what's very, I think, notable this time around is that this divergence is an extremely high, And I think this can be very well explained by the economies closing down altogether due to the global pandemic. But that's also something we point out in the report. This will be a very important thing to watch. How will the reopening of the global economy affect the inflation dynamics going on forward? And as I said, we expect there's a lot of potential for further rising inflation due to the huge amounts of liquidity out there. So, average inflation targeting, what is this? I think this is important to point out. This has been going on in the US. It was discussed as a measure of central banks, a different way how to manage the price stability of the currency. And it is, as I said, it has been basically decided in the US that the price inflation target isn't being defined as a ceiling anymore, but much more as a medium-term average of the inflation rates. So what we've got here is a graph which shows a ceiling of 2% price inflation. And the question which arises when one changes this monetary regime into an average inflation targeting regime, well, what kind of average does one calculate? And over what kind of period does one actually calculate this average? And in this regard, central banks have been very opaque. They didn't give a concrete formula how they would calculate this average inflation rate. So that's why we calculated some kind of scenarios or some kind of different ways which would be possible to calculate this average inflation. And if one goes back to the last 8 years, for instance, where one had this, as it is called by central bankers, undershooting of inflation, that was, just as a reminder, not a falling price environment, but just an environment where prices didn't rise as fast as they would have liked them to rise. So the idea is now to actually make up for this slower than desired price increases, and how much price inflation would be basically viable, so that one can have a result of 2% in the medium term. So if one takes up this lower than desired price inflation from the last years and wants to make it up, for instance, in 18 months, then central banks would have the leeway to let inflation rise to over 5%. If one takes this backlog and stretches it out more over 4 years, then the leeway would be basically roughly at 3.5%. So this is, in our view, quite significant, because 3.5 years of inflation at 3.5%, that's quite something. But what's even more concerning about this is the question how central banks will act once they reach these higher levels, wherever they are, and how are they going to act if they want to rein in the inflation. And there is, I think, an old saying among central bankers that is, don't let the inflation genie out of the bottle. And I think central bankers are playing with fire, and this is something which we are pointing out very critical. So what happens if inflation rates rise? One consequence usually is that yields rise. So bonds are less valuable, they are sold, and therefore the yields of the bonds rise. But this is obviously a problem, as we are in a state of over-indebtedness. And that brings us to the next measure, which is probably going to happen in either an implicit or an explicit way. It is yield curve control. So yield curve control is basically a price targeting for long-term yields, and it's again has the effect of a huge increase of the monetary supply. It's a QE with no quantitative limit. And we saw this already historically happen. So perhaps the well-known precedent is the US after World War II. The situation in terms of debt was quite comparable. Obviously, the war cost a lot of money, and the financing was done through a lot of debt. So also back then, basically the Federal Reserve and the Treasury teamed up together, and the Federal Reserve controlled the yield curve so that the states could finance themselves cheaply, which led to extremely negative real rates. Inflation spiked to 20%. And so investors of these bonds obviously had a very, very bad deal. And this is something which we could imagine also, perhaps not 20% inflation rate, but basically the environment of coordination between the central banks and the governments to be able to reflate the debt. So yield curve control is, in our view, very likely, especially once this inflation is going to build more and more pressures on the bond yields. So now just also a word on an ongoing development which we have been covering for many years now, and that is de-dollarization. This year also we have a chapter on the de-dollarization. The de-dollarization is increasing actually if one looks at the reserves, the international reserves, which are held by international central banks around the world. So obviously the current monetary system depends on this reserve status of the US dollar. And what we see here is the percentage of reserves which are internationally held and which are denominated in US dollars. And last year, this percentage hit a new low. I think it was the lowest since 1995 with 59%. So one can say, yes, the dollar as a reserve still has a dominant status, but in our view, the trend is pretty obvious. This state is decreasing. I think this is driven by many factors. On the one hand, a lot of international actors are critical towards the financial situation, are critical towards the monetary policy. So that makes them probably more aware of perhaps not reinvesting their current dollar reserves. But also a very important vector in this respect is the geopolitical situation. We addressed this also in the report, the East versus the West, East being mainly China, but also Russia and some of allied states versus the US and allied states. This is something which has been going on for quite some years, and this is also something which plays into the de-dollarization topic very much. On the other hand, we have gold reserves. So this trend is exactly in line and has been going on since 2008. Central bank gold reserves continue to build up. also, again, being driven by the rest of the world. So not so much developed markets, but emerging markets are increasing their gold reserves. Turkey increased their gold reserves. But also European countries like Poland and Hungary are increasing their gold reserves, or are talking about that to continue to increase their gold reserves. So I think this trend will also hold up in the future. I think before 2008 we had 27 consecutive years of falling gold reserves, and now we are in the 12th year of rising gold reserves again. So this is a very long-term trend which one can observe, and again, I think this is a confirmation of what we have been saying. So, as Ronnie mentioned, last year we talked about a potential new cycle in commodities, and that actually so far has panned out very well. Commodity prices have been rising extremely since the COVID crisis. That was actually, you have some examples of some specific commodities which have been doing extremely well. Lumber in the US is such an example. But what our focus is really as an index basket of commodities, because in our view, these also reflect the potential price inflation again coming up, leading indicator for the price inflation. And if one looks at the very long-term chart, which we depict here, one can see some kind of super cycles. So one can see in this graph 10-year rolling returns if one invests into the commodity complex. And one sees super cycles. Obviously, we've been in a very disinflationary environment during the last decade, so commodities were a very bad investment. And this already has changed in the last year, and we believe that this could be actually a very sustained development, and this could last for quite a few years. And this is obviously very in line with our inflation scenario, which we are painting. So commodities could be very interesting also in the medium term. So what will this inflation do to general portfolios? So let's start with bondholders. I mentioned already bonds obviously are the worst asset class to hold during an environment of inflation. Fixed income is very bad if the purchasing power declines, especially long-term bonds. So what we are seeing here is negative yielding bonds. We have still a huge chunk of negative yielding debt out there. It has been declining a little bit recently, but this is obviously somewhat inverse related to the gold prices, because gold doesn't yield anything, so that's an advantage to negative yielding debt already also on a nominal basis. And this is as a small example of what I just mentioned. What can happen to a bond if the yields start to rise? And obviously it depends on the duration of the bond. And we've took an extreme example. Austria's government issued a 100-year government bond. And a few years ago, so it's, I think, still running perhaps 95 years from today. And it has been very performing very well recently till the beginning of the year, but a disastrous performance since the beginning of the year. So actually it lost 36% percentage points in a few months. So this is just an example. Watch out for duration risk. Well, negative correlation between equities and bonds was basically the pillar of the multi-asset portfolio. So bonds and equities are the main components of multi-asset portfolios still today. But this, as I said, relies on a low or even a negative correlation, because due to this negative or low correlation, the diversification effects between those two asset classes are very favorable for the investor. But if one looks at the long-term relation between the correlation between these two assets, one can see that it is actually quite an exceptional time which we recently saw in the last 2 decades, that this correlation was so negative. And here also the thing that we want to point out, inflation could be detrimental to this negative correlation for bonds and equities. Because equities usually like an inflationary environment if it's not that inflationary. There's some kind of level, somewhere between 2 or 4 percentage points of inflations, where an additional rise in the price level actually has negative consequences also for the equity markets. So that's the reason why we are pointing out inflation-sensitive assets. What kind of assets can protect portfolios during such a potentially inflationary environment? And in terms of asset classes, commodities actually have the highest inflation beta, as one can see on this table. Gold has also a very high inflation beta. Apart from that, there's not really that many asset classes where one can hide. REITs, real estate investment trusts could be still a little bit positively correlated, and also TIPS, so inflation indexed bonds. But other than that, the typically financial asset has a negative inflation beta. Finally, from my side, the phenomena, digital central banking currencies versus decentralized cryptocurrencies. What we saw last year, a big rise, especially in the price of Bitcoin, but all of the cryptocurrency sectors. We don't think that Bitcoin was the main reason for the correction in the gold price, because that was suggested by some analysts. It may have taken some kind of market share, but we don't think that that was the significant reason. I think a comparison in the market shares shows how big still the gold market share is relative to the crypto share. But still, we do think it's an interesting asset class to follow, and perhaps even to diversify one's portfolio with a very small share.
Thanks, Mark. Not as volatile as Bitcoin, but still pretty volatile, is silver. Last year, our compliance department almost paled when we said, well, sell everything, take leverage, and just buy silver. Was, of course, just a joke. But last year, the gold-silver ratio was at 125. So with 1 ounce of gold, you could have bought 125 ounces of silver. This corrected dramatically, as we have expected. So now the gold-silver ratio is at 70. But as you can see on this chart, the silver bull market is already quite long, but we haven't seen this trend acceleration yet. And in the report, we've got a special chapter again, where we describe why we think that the consensus is wrong, why we think that investment demand will be the main driver in the silver market, and why we think that it actually might turn out as a silver decade over the next couple of years. Another interesting topic that we want to highlight is the enormous profitability of the mining space. As I've said before, we saw the most profitable year when it comes to free cash flow generation in 2020, and this year will be even better. Last year, we conducted 120 company meetings with companies from the mining space, and sometimes we felt like attending a deep value conference. So, as Warren Buffett said, price is what you pay and value is what you get. We think that we're getting tremendous amount of value in the mining space. And as you can see here, this is just a fun comparison. This is based on 14th of May 2021. Dogecoin, which doesn't have any meaning at all, is more of a meme cryptocurrency. It has had a significantly higher market allocation, market cap than the two largest miners, Newmont Mining or Barrick Gold. Those companies producing 5 billion in free cash flow last year and employing more than 30,000 people. So it shows us, I think, where the real value probably is. And as you can see on this chart, pretty similar like in the silver space. This is a long bull market, but we have not seen this trend acceleration yet. Now, many people ask us, is gold already too expensive? Our clear answer is no. Compared to the inflation-adjusted price, the all-time high from 1980, gold would have to rise to $2,300 to make a new inflation-adjusted all-time highs. And we've got many, many charts in the report highlighting that gold at these levels is actually pretty inexpensive at the moment. A quick technical analysis, we've got charts on the sentiment, which is not as bearish as it was in March, but still it is not extremely optimistic. And this beautiful, if you want to talk to a technician, this is really a textbook cup and handle formation, which would have a price target at $2,700. This year, again, we've got a new price model based on the options market, which is suggesting that the probability of gold making new all-time highs this year is significantly higher than making one-year lows. So from our point of view, the $2,200 is our fundamental view that we could go in this direction, but also the options market is pretty in line with our expectations. Now we're already coming to the conclusion. I hope we still have some time for questions. We are absolutely certain that a monetary climate change is going on and that gold should profit from this climate change. We think that the price of gold is in a very, very healthy bull market. We saw a correction over the last couple of months, but this correction is over, and we think that gold will make new all-time highs this year. So thank you very much for joining us on our golden journey. As you can see, we've got many publications that we give out totally free of charge on our channels, on our webpage, etc. And I hope that there's still some time for questions.
We have some questions. The first one is regarding the correlation of Bitcoin and gold, what your take on this issue is. And a further one on Bitcoin and gold. It seems that Bitcoin has stolen the scene from gold in recent months. Do you think that this will go on, or whether this will fade in the coming months? And the second question is, what is your view on the inflation versus deflation narrative?
Well, then I take the first question, if I may. Bitcoin and gold has been correlated negatively, slightly negatively, but generally I'd say around zero-ish. But this correlation, as mostly every correlation, changes over time. So we saw a higher correlation after 2020, after March 2020. Both assets first sold off and then came back rallying. But the correlation then dropped once gold stopped its bull market in August, and Bitcoin continued its bull market, or actually accelerated its bull market. So the correlation changes. We don't think that this Bitcoin run-up was the main, definitely not the main argument or the main reason that gold perhaps underperformed or consolidated. Both assets have risen in tandem, as we already saw, so that can happen. But it may have played a role that also we acknowledge. But we do think gold, really the main impact factor of gold are real rates. So the movement of inflation rates minus, interest rates minus inflation, and as we pointed out already, this changed in August 2020. So gold is acting as it actually always acts. And Bitcoin is a little bit of a wild card. It's acting a little bit as a risk asset. It's acting more as a risk asset in my view currently. We expect continuously low correlations between gold and Bitcoins, which by the way makes it interesting combining in a portfolio as a diversifier generally.
The big question on inflation versus deflation, we think there's quite a number of deflationary factors. But as we point out in the report, those deflationary factors are getting weaker and weaker, and the inflationary factors are turning stronger. So the pendulum is swinging into the direction of inflation. And inflation is not a point in time, it is always a process. And in the report, we explain the short-term, the medium-term, and the long-term drivers for a more inflationary environment. So clearly, there are still deflationary factors, but the inflationary drivers are overwhelming. I think that's it. Thank you very much for taking the time. Wherever you are now, we hope that you enjoyed it. Thank you very much for being interested in the topic of gold and everything around. We hope that you will enjoy reading and studying the report as much as we enjoyed writing the report. And thank you very much, and see you at the very latest next year. Thank you very much.
Take care.